Before a small business makes a big purchase, new equipment, a delivery van, a software contract, the riskiest mistake is judging affordability by profit or momentum alone. Hidden cash flow problems can lurk beneath rising sales and clean profit and loss statements, then surface right after you commit, when payroll or taxes come due. In this explainer, we'll decode 4 specific signs that your cash is tighter than it looks: receivables stretching, inventory creeping up, supplier bills getting pushed, and growing reliance on short-term financing. You'll see how each sign forms, why it's often invisible until too late, and how to test a purchase against your next 13 weeks of cash. Master these signals, and you'll avoid costly buys, negotiate smarter terms, and protect runway even during growth. Cash and profit often disagree because accounting recognizes revenue and expenses when earned or incurred, not when cash moves. You can ship an order today, profit up, but collect in 45 days, cash later. Meanwhile, you paid payroll and suppliers this week, cash out now. The working capital cycle, how quickly you turn spending on wages, materials, and overhead into collected cash, determines whether a purchase is safe. Key timing points include invoice terms, collection practices, delivery to billing delays, deposits, and taxes. A healthy profit can coexist with negative operating cash flow if receivables rise, inventory builds, or payables timing changes. To avoid a regrettable buy, we need to visualize this timing with a simple cash timeline and watch the few ratios that reveal it early. The first hidden sign appears when sales grow, but your bank balance stalls or falls. On paper, you might show a healthy gross margin and even a net profit, yet operating cash flow is negative. What usually changed? Accounts receivable expanded faster than collections, or billing lagged delivery. Example: sales rise from $100K to $130K per month, but receivables jump from $60K to $110K, and cash declines by $20K even before a new hire or equipment buy. Payroll, rent, and tax payments don't wait for slow remitters. The pattern: rising revenue line, flat or dipping cash line, and a swelling receivables balance crowding your balance sheet. It feels like momentum, but it's a self-financed loan to customers, riskier before any new purchase. To confirm sign 1, look at 2 simple views: aging and DSO. Aging shows how much of your receivables sits in 0 to 30, 31 to 60, 61 to 90, and 90-plus day buckets. Watch the right-hand buckets swell. Days sales outstanding, DSO, translates this into a single number. DSO equals accounts receivable divided by average daily sales. If AR is 110K and daily sales are 4.3K, DSO is about 26 days. If AR rises to 160K with similar sales, DSO climbs to 37 days, an 11-day cash delay. Also scan dispute rates and invoice cycle time, days from delivery to invoice sent. When DSO rises and aging shifts right, a purchase that looks affordable can trigger a squeeze before you collect enough to cover it. The second hidden sign is inventory creep. Stock levels drift up faster than sales velocity. This inflates working capital and quietly absorbs cash. Symptoms include more purchase orders to be safe, wider SKU assortments with slow movers, or seasonal overbuys that linger. Track days inventory outstanding, DIO, and inventory turns. If turns fall from 8x to 5x, you're tying nearly 60% more cash into shelves. Example: average inventory climbs from 75K to 120K, while monthly cost of goods sold holds near 60K. DIO jumps from about 38 days to 60 days. The risk: reorders arriving while older stock still sits, markdowns necessary to move it, storage costs rise, and cash that could fund a strategic buy is locked in boxes. Pushing supplier payments later can temporarily protect cash, but persistent stretching is a warning sign. Watch your payables aging. When 31 to 60 and 61 to 90-day buckets expand, you're borrowing from vendors. Costs escalate if you forego early pay discounts. A common example: 210 net 30. Skipping a 2% discount to pay 20 days later implies an annualized cost of roughly 36% plus, far above most financing. Risks compound: strained supplier relationships, reduced priority on rush orders, holds on shipments, and COD demands that spike cash needs. If you're considering a purchase while several key suppliers show aging beyond terms, The transaction may be funded by goodwill that's running out, turning a manageable buy into a crunch when a shipment is held. The fourth sign is increasing dependence on short-term financing to plug everyday gaps. Revolving credit lines pinned near the limit. Credit card balances carried month to month. Factoring or merchant cash advances with daily debits. Individually, these tools can be fine. As a trend, they reveal a structural mismatch in cash timing. Watch utilization rate on credit facilities, interest expense as a percentage of gross margin, and coverage. How many weeks of average operating outflows your unused line could fund. Example: a 100K line with 85% utilization, interest expense rising from 2% to 5% of gross margin, and daily MCA withdrawals eroding net cash collected. A new purchase layered onto this stack magnifies interest drag and narrows room for error. Before committing to a buy, run a quick stress test. Ask: 1. What happens to cash balance for the next 13 weeks if the purchase proceeds on quoted terms? 2. What if receivables arrive 10 to 15 days later than usual, or top 2 customers delay one payment cycle? 3. What if we only achieve 70% of expected uplift from this purchase during the first quarter? Example: a 25K machine with 30% deposit now and the balance over 12 months. Map deposit, delivery, and first payment dates against payroll, rent, taxes. If any week goes negative without extreme supplier stretching or new debt, pause or negotiate. This shifts decisions from hope to visibility, reducing the chance a routine buy triggers a liquidity scramble. You can build a lightweight yet powerful 13-week cash flow on a single page. For each week, list expected collections, new sales to be collected that week, and other inflows, loans, tax refunds. Then list outflows: payroll, rent, COGS purchases by expected payment week, taxes, debt service, and the proposed purchase costs. The math is simple. Starting cash plus inflows minus outflows equals ending cash, which becomes next week's starting cash. Flag any negative week. Then experiment. Pull collections forward with reminders, delay optional spending, or split the purchase into phases. A 13-week view is short enough to predict with reasonable accuracy and long enough to expose hidden dips masked by monthly summaries. Maintain a small dashboard to catch issues before they hit the bank. Track DSO, receivable speed, DIO, inventory days, DPO, payables days, and the cash conversion cycle. CCC equals DSO plus DIO minus DPO. Add a quick ratio: cash plus AR, current liabilities. Trends matter more than single points. Example thresholds: DSO trending plus 5 days over a quarter, DIO creeping plus 7 days, DPO jumping plus 10 days without renegotiated terms. CCC expanding for 2 consecutive months, or quick ratio falling below 1.0. Pair ratios with alerts: aging buckets shifting right, or suppliers applying holds. With a dashboard, the 4 hidden signs become visible patterns you can act on before authorizing discretionary buys. Address the drivers underlying the 4 signs before committing to a purchase. Accelerate cash in, tighten invoice timing, require deposits, offer small early pay incentives, automate reminders, and resolve disputes faster. Release cash from inventory. Forecast realistically. Cut long-tail SKUs, set reorder points, run targeted markdowns for obsolete items. Extend cash out smartly. Negotiate terms aligned to your conversion cycle. Use early pay discounts selectively where ROI beats borrowing, and calendarize payments to smooth spikes. Reduce reliance on high-cost short-term debt by stepping down utilization and replacing daily debit tools with structured facilities when appropriate. Even modest improvements, a 5-day DSO gain, a 10-day DIO reduction, or spreading a purchase into phases, can restore weeks of runway and turn a risky buy into a safe one. Turn insights into a decision rule. Green light when dashboard trends are stable or improving. 13-week plan shows no negative weeks in base and mild stress scenarios, and utilization of short-term credit remains comfortably low. Amber light, delay, or phase, when 1 to 2 signs are flashing, negative weeks appear only in stress scenarios or supplier terms are tightening. Red light, pause, when 3 or more signs flash, base case weeks go negative without extraordinary measures, or payables aging shows relationship risk. If amber or red, negotiate. Split the purchase, seek delivery-based payment schedules, or attach performance contingency. Document the decision with metrics and review in 30 days. This disciplined rubric keeps momentum without gambling runway, ensuring each purchase strengthens, not strains, your cash position.